And so for those businesses where that are thinking about what's the right kind of instrument to finance my growth, I think they really have to sit back and really think hard about what really is the cost of capital.
Welcome back to the Adventure Capital Podcast. We're here today with Keith Harrington, the co-founder and managing director at Novel Growth Partners. They provide capital for early-stage software startups with potential, which is exactly the kind of spirit we love here at Wefunder. Enjoy the episode, and let's get to know Keith.
So, Keith, welcome to the podcast today.
Thanks, John. It's great to be here.
Maybe you could get started. Just give us an introduction to Keith Harrington and Novel GP.
Yeah, sure. So I'll start with Novel. We are a revenue-based financing firm based here in Kansas City. My partner Carlos and I launched the firm almost 3 years ago. Actually, we really got serious about this in the summer and fall of 2017. So since then, we launched our fundraise. We had our final close on the fund in October of last year, October of 2019. We've made now, as of today, 23 investments, and we're really cooking with gas. We're firing on all cylinders. Johnny, I think it's interesting. I got really excited about the revenue-based financing space at a meeting where you and I met for the first time in Kansas City. At the Kauffman Foundation. There was, I can't remember what they called it. It was a moonshot design session or something about microfinance and different ways to provide capital to businesses.
That was a fun session.
It was.
I met you. I also met Andrew Yang.
Yeah. No offense, but when I tell this, no offense, but when I tell this story, Andrew Yang comes up before you do. So
that actually is quite offensive to me. Maybe you could flip the ordering of that going forward. But
yeah, that was a really cool session. A lot of really interesting people there. It was great to meet you. I kid, but that's
how you got excited about revenue-based financing. What was your story before then? What's your background personally?
Yeah, so before that, I was on the venture capital side of the table. So I was actually looking for unicorns, 100x deals that we could deploy capital into and watch them really blow up. And I've been doing that for about 9 years at that point. I had originally been investing for the state in using a place called the Kansas Bioscience Authority, where we were investing.
The state of Colorado.
State of Kansas, actually.
Okay.
Yeah. It's called the Kansas Bioscience Authority, and we were charged with investing in life sciences companies in the state of Kansas, and also trying to build the ecosystem in the state of Kansas for life sciences companies, especially at the early stage. And I did that until 2015, and in 2015, along with some co-workers there, co-founded a fund called Fulcrum Global Capital that was focused on early stage venture investing in the ag tech space. But all along the way, I kept having this experience that eventually was very frustrating for me. I would meet with entrepreneurs who had, great businesses, interesting people who I wanted to help, but because of the format of the capital that I had at my disposal, it wasn't a good fit, right? So I kept saying no. I kept shrugging my shoulders when an entrepreneur would say, "Well, if not you, then who?" And there was just a point where I was like, "This doesn't really work for me. This isn't that great." And so and pile on top of that, there was also a point where being so singularly focused on the ag tech space, it just didn't appeal to me anymore. And I started really thinking about, okay, what is a way that I can have a much broader impact with the limited skills that I have? What can I do that is going to be more meaningful? And so, at first I thought about, well, I'll just do what every other, middle-aged guy in the Midwest does, and I'll raise a seed fund focused on the Midwest, right? And I started thinking about it, and I did some research, and I realized I'm going to do that, and I could probably raise a little bit of money and run a fund, but I'll look back after a while on a mediocre career as a seed fund manager, and that's probably not what I want to do. because there are a lot of people out there smarter than me and better than me at this. And it doesn't solve the problem that I'm still going to meet all these entrepreneurs that I can't help. Mm-hmm. So while I was trying to figure that out, I was talking to the Kauffman Foundation a lot. I was helping them with a couple of projects and microloans and microfinance. And then I happened upon, they invited me to that meeting. And so it was at that meeting, for me, that was a transformational event.
Really? So did you learn about revenue-based financing at that meeting?
I didn't really know what revenue-based financing was. I was familiar with it because, as it turned out, when I was working for the Kansas Bioscience Authority, we actually did deals structured very similar to what I do now today.
It just
wasn't. But we didn't call it revenue-based financing. We just called it clever.
And that's we just called it like a good way.
We just thought it was a good idea. Yeah.
Well, so that's actually a good place to just pause for a second and say, for anyone listening, what is revenue-based financing? How does it work? How is it different from conventional equity venture capital investing?
Yeah, so it's revenue-based financing it can take a number of different forms, but I'll just keep it super simple. Rather than it's capital that comes into a company, usually to fund growth, and rather than take the form of an equity investment where an investor is putting in money and then getting a piece of the business, an ownership stake in the business, and in some cases control provisions in the business. Revenue-based financing, actually, the capital comes in and then it gets paid back as a percentage of revenue that the company generates. So you can also think of it, some people call it revenue share, some people call it royalty-based. It really functions like a royalty. And different investors use different mechanics to make that work. But at the end of the day, it's minimally or not at all dilutive. It's usually a pretty meaningful amount of capital for the companies that take revenue-based financing, and it gets paid back over time based on that monthly revenue. And that's a really key and I think important.
And it's a loan versus an investment. Yeah,
it is a loan, and that's also a key difference, right? It's not an equity investor writing a check and then sort of letting it ride, and hoping for a big outcome. Revenue-based financing investors like us at Novel, we're looking for 1.5 to 2 times the money that we put in. So we structure it where the royalty gets paid up until we get back that 1.5 to 2.0 times the money that we.
I was going to say, so I'm kind of curious about typical terms and then typical kind of companies that are a good fit for this method of financing. So on the terms front, Wefunder, when we do revenue share deals, there are, I feel like, kind of 2 primary parameters, right? The first is, what's the multiple? You were just saying 1.5x to 2x, i.e., if you invest $1 million in a company, then they're going to pay you back $2 million if it's a 2x multiple on the deal. And then there's the other parameter being the percentage of their usually net revenues that they're going to remit every month or every quarter until they've paid back the $2 million. So are there other parameters that go into structuring these deals? And can you talk about kind of what a typical, or what the range looks like in terms of terms for you at Novel, or like other revenue-based investors, kind of what the range looks like and what a typical deal might look like?
Yeah. So the terms are usually, at least in our case, it's pretty simple. And that's the way that we approach our investing, is we try to be as transparent and frankly as simple as possible. We think entrepreneurs have a lot of hard things to figure out. Understanding how it is that we're working together shouldn't be one of those. So for us, there are some ranges that we tell entrepreneurs to think about when we first meet them and start talking about a potential partnership. So first of all, we can invest usually up to about 30% of a company's existing annual revenue. So if a company has $1 million,
is that trailing 12 months or is that ARR?
Great question. Yes, trailing 12. That's a great question. And so, if a company has $1 million in trailing 12 revenue, then
you can do 300K.
Exactly. Usually up to 300K. And there are different dynamics of the company that might make that less, might make it more. It just depends on what that company looks like, in terms of growth rate and in terms of stability. So that's thing one. Thing two is, as I said a minute ago,
you're just making me think of Dr. Seuss. I've got a 4-year-old and a 2-year-old. So
I said thing one and thing two, didn't I?
Thing two, I'm thinking the cat in the hat.
Yeah. That's actually that's why I say that, and nobody ever catches the reference and says anything to me.
Thing two.
Well done. And then so, when our terms are usually the royalty on revenue is usually 4 up to 8, sometimes all the way up to 10%. It just, again, depends on the company. Okay. And it's not, you said something really interesting. Different revenue-based financing investors do this differently. We take we don't use net revenue. We don't even look at the P&L for payment calculation. Mm-hmm. But we use actual gross cash receipts from product and service sales. So the cash that lands in the company's bank account that is generated by product and service sales, that's the number that we generate, that we use for the royalty calculation.
Got it.
And that makes it really tailors it to how the company's doing, right? A lot of the companies in our portfolio are seasonal, right? So we have a lot of education businesses in our portfolio, right? So there are super lean months where nobody's paying any bills, and then there are big months where everybody's paying their bills.
Yeah,
and this allows.
This is like it's kind of interesting. I'm curious to get into this with you over the next few minutes here, but it's like you can compare it to a loan, or you can compare it to an equity investment, right? And certainly compared to a loan, I always think for a founder, it's like it's more flexible, right? You say there's kind of flexibility around seasonality. There's also flexibility around if like it's a tough year, or if it's a pandemic and revenue drops, then the kind of repayments on the loan drop. So I think it's kind of nicely aligned for a founder in terms of syncing their cash flows with the repayments that are owed on the loan here. But that's thing one, i.e. kind of 30% of trailing 12-month revenue is the kind of max investment amount, give or take. 4% to 10% of gross revenues. What is that like paid every month, every quarter? And you said 1.5 to 2x multiples. Are there any other kind of things that go into the size and shape of a deal?
Yeah, so it's usually, you're right, it's 4 to 10%. That's one that and the payback gap is usually between 1.5 and 2 times the money. That's usually over 3 to 4 years.
3 to 4 years. So you model it out and you say, okay, based on this continued growth rate, you're going to pay back kind of 2x over 4 years.
Correct.
And then based on that projection, then which can be up or down, right, as opposed to a term loan. But based on that projection, then you can back calculate an APR.
Yes.
And so do you have a kind of a sense of an average like projected APR based on the forecast revenues and repayments when you're making these deals, like kind of 25%?
Yeah, it's usually, I mean, if you look at it, it's usually mid-20s. The interesting thing about these kinds of investments is that if a company grows much faster and pays us off, faster than we anticipated and modeled, then that APR actually is a little bit higher, right? So
that is interesting.
Yeah, so we don't actually, when we look at it, we don't.
Which is kind of good, right? That's another way in which I feel like these rev share repayments are better than a standard loan for a founder, because if the revenue explodes, they end up paying a higher cost of interest. But conversely, if the growth is slower, then they pay a lower APR, which is kind of what you want.
Exactly. So, when we're working with a company, we don't have because the payments are variable, and it really depends on how that company is growing. Mm-hmm. We can't say here's what we think the cost of capital is going to be. So we think about it very much in terms of the multiple of cash on cash, right? Is it
right?
This is going to be 1.6x, or whatever.
Yeah.
So yeah, and then you asked if there are some other things that really kind of help shape the deal when we make an investment. For us, it's how much revenue the company has. So we do deals with companies that have a minimum of $500,000 in revenue trailing 12, up to $5 million in revenue trailing 12, and also growth rate. So we look for growth rates of 30% or more. So again, it's so different from the equity world where You need 30% month over month, right?
30% is very boring.
Yeah, 30% of the equity world, that's a complete and total failure. I think 30% growth
just to kind of touch on that for a second. I mean, going back to the kind of the vision, your aha moment at the Kauffman Foundation in 2017, right? That's the whole point, right? Which is a 30% annual growth rate for a business doing $2 million in annual revenue. It's amazing, right?
It's a beautiful business,
that rather than
exactly.
Saying, "Oh no, we can't fund that business."
Right, and that's the weird just fallacy that entrepreneurs are taught, that venture is the only way to finance their businesses. Right? Come up with your idea, go do a couple pitch classes, and then wow somebody with your idea. And if you get to $1 million in revenue and you're going at 30% a year, then it's not going to be sexy enough, and that is. It just doesn't make any sense, right? It doesn't make sense. And that was, and it was me walking into the Kauffman Foundation that day in 2017 with that in mind. And I met Ross Baird, and I met you. I met a couple of other folks who were either on the periphery of the revenue-based financing space or who were doing it. And I had 4 or 5 conversations that it was just lightning struck. I was like, I want to go figure this out.
Amazing. So what about, I chatted with the guys at Lighter Capital the other day, and they were talking about a few kind of criteria that they have for founders that they invest in. And one was, kind of technology was a key component of the business. I would imagine maybe there's a kind of target gross margin that you guys have, or is there also kind of a requirement for the company to be kind of, net profit, in the black? Are there other kind of criteria beyond? You said at least $500,000 trailing 12 months revenue, growing 30% year over year. Are there any other criteria that make a company a good fit for Novel?
Yeah, I'll kind of give you our sweet spot, sort of top to bottom. So, first of all, enterprise software, B2B software. We like to be able to work with companies who are either software companies or who are tech-enabled services. Right?
Got it. So you're limited to B2B software.
Those are the markets that Carlos and I know really well,
right?
And can actually where we can actually help the company. A company needs to be, as you said, $500,000 to $5 million in trailing 12 revenue, growing at 30% a year. We don't need a company to be profitable, but we need them to be not, massive net burners of cash. So we look for companies that are if they're not profitable, they've got line of sight on it, and the CEO
flirting with profitability,
and they're looking for it, right? That's what they're managing towards, trying to get to the point where they're managing
and obviously, if they're growing 30% annually and they're a B2B software company, then if they're close to it, they're not going to be far away.
Right. And then, one of the things that is that's really important to us is when we talk to the CEO and we talk to the management team, we want them to be hungry for a particular kind of help. So we are sort of fanatical about the idea that revenue is the most important thing to focus on. And so, you know as well as anybody, revenue is the cheapest capital that you could ever find, right?
Yeah.
And so what we aim to do with the companies in our portfolio is actually help them improve their growth engine. And we actually have a structured way in which we do that. And so when we talk to companies, if a CEO feels like, hey, I've got sales and marketing all figured out and I don't need any help, that might actually not be a great fit for us, because that's where we can really help. And it's where we want to help, because we've actually got an operating partner on board who's been with 3 different startups. A couple of them have exited. And he was the guy who built the sales teams. So we've got some real expertise on that in-house that we like to provide to the companies in our portfolio. We do.
What's one tip for a company that you invest in, like a classic kind of example way in which you can oftentimes help them to kind of drive revenue growth?
You know what's funny? So one of the things that we see a lot, especially in early stage companies, is, and I think it's because CEOs are almost afraid to ask for it, but just making a contract auto renew, so that you're retaining customers a little bit more easily. Just that simple thing can make a huge difference. We see a lot of early stage software businesses where the CEO has to go back out and resell that customer again, right? It's a renegotiation.
That's so interesting. That's such an amazing thing. It's like a one tiny little thing that has massive implications.
I wish
we had a recurring. I mean, we have a lot of founders of Wefunder come back and do repeat campaigns with us, but it's certainly no box we can check on.
Build it into you can build it into the agreements that next time you raise money, it has to gotta come back to it. Give us the first shot.
Yeah, well, that's a really cool example.
And this is the really cool thing I think about the businesses that we work with is they're all very different, and the CEOs of these companies are all very different, and they're tackling different challenges, and that's an amazing thing. What's fascinating is at different stages of a business's evolution, at different stages of their journey, their problems aren't all that dissimilar, right? So we know that up to about $1 million or so bucks in revenue, that CEO is doing most of the selling, and that CEO is probably not very good at selling, which is not, I don't mean to be pejorative, it's not an insult. If you haven't been trained, like if you're not a trained salesperson, it's hard to do. So, we see CEOs that get their companies to $1 million bucks in revenue by brute force, right? Just
that's interesting. Do you train the CEO then on sales strategy?
We will help them with sales strategy. We'll also help them bring in salespeople, or maybe that first sales executive.
Who have that experience and do know how to navigate enterprise sales.
Yeah, so there are three things that we do after we invest in a company. We call it our revenue acceleration platform, and it's sort of three pillars around which we organize our work with the company. First is helping them master strategic focus. So you're in a company with $1 million bucks in revenue, $2 million bucks in revenue, $3 million bucks in revenue. Your hair is always on fire. Right? So we help them with a very simple and templatized approach to developing a strategic plan that has owners and dates that they can actually execute against. And it's a one-day process. We do it with them once, and then they've got a process that they can use going forward. Not every CEO wants to do it, and that's okay. But the ones that have taken us up on that have been able to actually align themselves and their teams with their vision and then go execute. And then we also work on sales process. And so, our operating partner is phenomenal at this stuff. He works directly with the CEOs, directly with the sales teams to help them really
CRM, automation, that kind of point you made earlier about auto review.
Exactly. So we and when we're doing our diligence on a company, that's where we focus most of our time. It's like, how's your sales process? How are your contracts? How do your relationships with your customers work? So that when we're done with diligence and we're investors, we can actually help. And then the final thing that we'll do is, as I mentioned a minute ago, we'll actually help them bring in that key next hire in the sales area. So we'll actually we've interviewed potential sales hires, helped them screen. We see one of the mistakes that we see a lot of companies make is they hire the wrong salesperson and they lose 6 months to a year of potential revenue production and certainly salary. It's so hard to find a good one.
What's a common mistake when it comes to hiring salespeople?
One of the things that CEOs, one of the assumptions that CEOs make that isn't always necessarily true is that you have to have industry expertise in order to be successful in my industry. Right? If I'm in education, I can't hire a great salesperson who came out of a marketing SaaS business.
It makes sense to me that the quality of the salesperson would by far outweigh the kind of industry expertise.
That's one of the things that we try to share with the CEOs that we work with is that totally understand it feels like that industry expertise is going to be critical, but what's really most important in our experience is going to be that capability to build and execute a sales process that works for your market. And that doesn't really take industry expertise. That just takes an understanding of how the sales process works. And so that's a really simple one that when we work with the CEOs that we work with, that's a pretty simple thing that we help them understand. And it really opens up the funnel for them when they're looking for new salespeople. And then you can really zero in on actual, actual capability.
Very cool. So that's kind of how you guys help the founders you're investing into to kind of grow revenue. Getting back to the revenue share structure, why, who is this a good fit for? Like, when does it go from like you're getting a loan from a CDFI or a bank? When does it make sense to do revenue share versus like raise equity capital from a VC? Like, what's the sweet spot?
Well, I think the interesting thing about revenue-based financing is that there are multiple sweet spots, right? If you kind of step to the side of it and you look at it through the lens of an equity investor has a very narrow set of things that she can do and invest in, right? Just based on metrics. And it has to look a certain way. For revenue-based financing, the aperture is much, much wider.
Right.
And so for us, and I think this is true of most revenue-based financing investors out there, we've and in our portfolio, we've invested in companies that are completely bootstrapped, never taken a dime of outside money. We've also invested in companies that have angel backing. We've invested in companies that have institutional venture money in, and we've invested in companies that have institutional venture debt money on their cap table. So for us, we're really flexible about how you want to finance your business, and we recognize that it is really a function of where you are in your journey. Do you want to take some money that's going to help you get to your next big milestone in a way that's non-dilutive? Then we're a great fit, right? If you want to supplement an existing equity round that you're raising and reduce the amount of dilution that you're taking.
Oh, interesting. So you have founders that are doing an equity round, and then they kind of they basically they give up less equity.
Exactly. So we've done our investments at the same time as, before, after angels, VCs, venture debt providers, and banks.
We hung out at another conference in Kansas City. I think it was last year. I think you organized it. Thank you.
I did.
It's so cool. Like from 2017, you learning about revenue-based financing. Now you're like the national leader, I feel like, on revenue-based financing. But one of the questions that came up there, and it was a kind of easy answer to bat away, but I'll just kind of throw up this softball for you to hit out the park here. Sure. Might a founder say, "Wow, 25% APR, that sounds like a pretty high cost of capital." What's the answer to that?
Yeah, so it kind of depends on what you have available to you, right? So if I'm a founder and I have a business that's growing, well, first of all, one of the questions that you asked a minute ago, and I think this is directly related, is when is our revenue-based financing a good fit? When isn't it? There are companies out there for which equity may be a better fit at a particular point in their growth trajectory, right? Or in their history, like when they don't have very much revenue and they need capital, and revenue-based financing just doesn't work, right?
So they want to invest everything back into growth as opposed to repaying a loan.
Well, that, or they're still doing product development, trying to find product market fit. Revenue-based financing really is a good fit once you've got product market fit and you kind of understand, if I put $1 into my machine, I'm going to get $3, $4, $5 out. But then your question about what about a founder who thinks that cost of capital is higher than they'd like to pay? Then in that case, you have to look at what are the options that are available to you as a CEO. Do you have access to equity, and does that make sense? And do you know how much that really costs? Because if you're wildly successful, equity is going to be massively expensive, right?
Yeah.
If you look at revenue-based financing the way that we do it, the most you're going to pay is 2x on the money over 4 years, right?
If you build a unicorn, then you're going to pay 1,000x on that quotes loan. Yeah.
Right. And so the better you do, frankly, the more expensive equity becomes, because they own a share of the business. That means they own a share of the value that you're creating. And that doesn't stop. And so for those businesses where they have access to, that are thinking about what's the right kind of instrument to finance my growth, I think they really have to sit back and really think hard about what really is the cost of capital. Because if you look at it along a continuum, you've got sort of revenue, which again is the cheapest version of capital that you can ever get. Banks, which are very, very cheap. And then there's us, right? And we're more expensive than a bank, but we're a hell of a lot less expensive than equity. Equity just doesn't feel like it costs anything because the check comes in. You're not giving anybody anything except for shares, which may or may not feel expensive at the time. But when you sell that business, depending on liquidation preferences and all the other features of that particular equity investment, that's when it starts to feel expensive.
Mm-hmm. You kind of hinted at this, but what's the downside of revenue share for a founder? I mean, this is kind of the opposite side of the coin from what you were just saying. But
yeah, I think the key downside is you have to pay it back, right?
Yeah, it ties up cash flows in the short term.
It does, but I think again it gets back to the idea that if you as a CEO are comfortable with your unit economics, so you can put $1 into your machine and get $2, $3, $4, $5 out, then as long as the margin between what you're paying for that capital and what you're getting out of your machine in terms of profit is big enough, then it makes sense to do it, right? Mm-hmm. But it's sort of it sounds like a flip answer when I say what's the downside, but that is, I mean, the downside is like a loan, it does require repayment.
What's you're kind of leading a movement around revenue shares here. You kind of you've been doing this now for a few years.
Yeah.
You talked earlier about kind of why there's a need for this movement, i.e., kind of entrepreneurs should not feel straitjacketed by kind of the homogeneity of kind of conventional VC. Have you learned any lessons about kind of over the last few years as you've started to do this? Like, have you kind of iterated on the terms of the revenue share deals that you're doing, or have you kind of learned about what types of companies it's a good fit for, or how to pitch it?
Oh yeah, I could talk for days on that question, Johnny. That's a great question. So yes, I think so. My partner Carlos was an entrepreneur in the ed tech space, and so I say this just as a little bit of backdrop. He came out. He sold his company to Vista Equity Partners in 2015. Along the way, building that company, it took him 15 years to get to that exit. He struggled with all the same kinds of problems that we are helping entrepreneurs solve. And one of the things that he got really good at was iterating. And so in our DNA as a firm is a consistent, just a constant learning loop, right? So every time we talk to a founder, we are basically learning more about how founders think about what we do. So we have modified terms, we've modified our approach, we've learned how to talk to entrepreneurs in a way that is, when we first started, it was sort of how I like to talk about stuff, which is super wonky and in the weeds of the deal. Mm-hmm. And we learned pretty quickly we got to step back and really make sure that the CEOs that we're talking to understand what it is that we do, because it wasn't very well known when we first got started, but it's becoming more and more widely known and accepted, which is great. But yeah,
is it like how? I mean, do you have any data on that? Like either like the growth in revenue share or like a percentage of like total, kind of like early stage investing or VC?
Yeah, so there's data I think being collected at this point that I think should be coming out fairly soon, at least this year, to kind of show the growth in the industry. I've seen, I'm sure you've seen Lighter Capital's report about how quickly their stuff has grown. I think Decathlon came out with a report not long ago and talked about I can't remember what the multiple was, but the number of investments and volume of investments using this revenue-based financing approach had gone up pretty significantly as a percentage. But the other thing that I think is a good tell that this is becoming more and more used in the ecosystem is that it is showing up in articles more and more frequently, right? It's actually every week that someone is talking about revenue-based financing. It's getting more and more. The volume on that conversation, the pace on that conversation is getting more and more. It's getting louder and louder. So, but the data, I think we'll start to see some really useful data closer to the end of this year, because there are a couple of folks really pulling together some interesting studies.
Very cool. And so, actually two more questions that we ask every guest right at the end. But the last kind of question on the revenue share stuff, what's really cool about this, I think, is that, you have bank loans, right, where there's the take collateral, low interest rate, kind of conventional debt. And then you have equity, which, as you say, is like, there's a tiny aperture, like, hardly any companies. The 30% annual growth on 2 million of trailing 12-month revenue SaaS company doesn't qualify, for either one. So like, just basically something in the middle. Oh, it's amazing. It's so good and needed. Are there other examples of kind of iteration and experimentation around like structures that might kind of add to the kaleidoscope of options that a founder might have at their disposal as they're trying to figure out their capital strategy?
Yeah, so I think this is a really exciting time right now to be sort of in that middle, trying to figure out how to help entrepreneurs in ways that aren't, banks and traditional equity investing. Right. And so there are a lot of things out there that are popping up, right? So I know I'm sure you're familiar with Bryce at NDVC. Yeah. His structure is great for companies that I think are a little bit earlier in their life cycle, perhaps, than what we look for.
That's like kind of pre-revenue share, right? They don't have $500,000 trailing 12-month revenue.
Exactly. And similarly, Tyler Tringus at Earnest Capital.
I actually met him at the event
in Kansas
City, which is cool.
Yeah, Tyler's
I now read his blog. He's a brilliant writer.
He's perhaps the most prolific tweeter I've ever seen. But yeah, so Tyler's approach it's a little different from Indy's approach, but again, looks to me to be really good for those businesses that are maybe a little bit earlier in their cycle than what we're looking for. There's and then there's a whole bunch of.
Can you just like articulate that kind of what the model is there, or what that investment structure looks like?
I'm going to butcher this.
I can try to help you.
We're going to get complaints from Tyler and Bryce.
Tyler can come on the next episode of the Adventure Podcast and correct butchering.
It's and so I'm gonna abstract a little bit. So it's the way that I understand Tyler, Earnest Capital, and NDVC both approach their deals is they'll provide capital, and then it's in the form of a kind of equity that then just gets bought back by the founder as the company grows, and it's a function of either revenue or maybe of net income or profit. Is the number that they multiply their percentage.
And it's basically optionality, right? That like if it turns out to be kind of on that unicorn like hockey stick curve, then it functions as a standard like safe or convertible note.
Right.
Whereas if it turns into kind of more of a 30% a year annual growth business, then the investor's going to get kind of paid out in more like a revenue share function. So it's kind of a little bit more optionality.
Exactly.
Yeah, I mean, thank you, by the way, for again hosting that conference and turning me on to all these this growing plethora of options. And so thank you for your leadership in leading the charge around revenue shares. I think it's just a great additional option for founders to have and be able to consider. And so, where would someone go to learn more about Novel?
Yeah, so you can find us at our website, www.novelgp.com, short for Growth Partners. So novelgp.com. And on the site, you'll see more about what it is what kind of companies we partner really well with, and then a little bit more detail around how we actually help the companies beyond capital. But that's a great place to learn a little bit more about us. And if anybody has any questions, they can get me at Keith it's Keith. I spell my name the correct way, at novelgp.com.
Is there another way to spell Keith?
Some people spell it IE. I don't know why that is. It doesn't make sense to me.
Yeah, I'm with you, man. We'll say, and then last two questions. One piece of advice for someone starting a fund, I guess, because normally we're talking to founders and it's like, a founder in the edtech space, but for you, it's like, someone starting a fund, piece of advice.
Wow, don't do it. No, I'm just kidding. I think I'll say two things about that. First of all, be prepared for it to be incredibly hard. Raising money for a fund, for a first fund, is incredibly difficult unless you're coming out of some sort of an entity that gives you a name brand and some sort of pedigree. Be prepared for it to be a very hard road, every bit as hard as the road that entrepreneurs travel to raise money. I don't think there's much of a difference between the two efforts. I think the thing that was most helpful to me along the way was having a mentor who had done it before, and who, when we were encountering difficulties or are in the middle of a complicated negotiation with a potential limited partner, I was able to call a guy who I knew who had raised funds before, who could say, yeah, don't do that, or here's a different way to look at it. That was critical. Find somebody who's done it, because they'll be able to empathize with you, which is going to be critical, but they can also give you really good advice, because some of this stuff is so esoteric, you'll bump into questions that you never even anticipated.
That's a great piece of advice. And the last question we normally ask is like kind of advice for a startup founder, but I feel like that advice around mentorship can work for that. And you gave some great ideas earlier on the revenue side. So we'll wrap it up there. Keith, thanks so much for your time. This has been a really informative conversation. I think, like, for anyone focusing or trying to learn about RevShares, this is a very valuable 40 minutes or so.
Oh, well, thanks, Johnny. This was a lot of fun. I really appreciate you having me on. This was great. Hopefully, we'll have ACS 3 sometime next year, and I'll
Alternative Capital Summit. That is
Alternative Capital Summit 3.
Yeah, I'll see you there, man. Thanks so much.
Thanks, Johnny.
Bye.
Thanks for tuning in to today's episode. If you enjoyed it, leave us a 5-star review and share it with your friends. We hope you enjoy chatting with Keith Harrington, and tune in next time for another episode of Adventure Capital.